Hello traders, Gary Wagner here. It is 12:50 in Honolulu, 5:50 in New York on Tuesday, first day of February 2022, and this is the daily report for gold and silver. For the two last consecutive days, we have seen modest moves in gold, with today's $4.90 gain taking April futures to $1,801.30. That is a net increase of 0.27%. When we look at the dollar index, that declined by 0.29%. So just as yesterday, we are looking at almost a wash between the bullish faction and the bearish faction, and their inability really to move the price in either direction. However, dollar weakness did provide gains for gold. A very interesting day for those investing in silver. Silver really took off in trading today, trading past the 50-day moving average to a high of $23.06. It definitely backed off of that price, but still managed to close up 1.1% higher, or 25 cents, with the March contract currently fixed at $22.64. On Friday, we began our discussion about the potential for the sell-off that began roughly a week ago had concluded. We based it on one simple fact, and that was the 78% retracement, which occurs at $1,784.90. And of course, that retracement set is simply based on the lows from November the 1st up to the highs on November the 16th. As I said yesterday, 78% is a deep correction, but it is viable and accepted level. A couple of variables are extremely noteworthy, and that is, on Friday, we identified a potential bottom, as I said, based on this retracement point. It opened just above the 100-day moving average, closed well below it. In yesterday's activity, you can see that it traded to a high above the 100-day moving average and then closed right at the 100-day moving average, acting as a point of resistance. That was the low today, and highs took it beyond the 50-day moving average, and it still closed just below, which currently resides at 1801.20, and we are currently trading overseas at 1801.10. Therefore, I believe that we have very minor resistance at the 50-day moving average, and our current strategy is to look to position ourselves from the long side. We are hoping that we get a dip anywhere between 1790 and 1795. If we see that occur, we will send out a trade alert to that effect, but we're hoping to position ourselves just below $1,800 per ounce. In terms of resistance levels, the first thing that we want to look at is recent highs or tops, with major resistance occurring at 1880, what we're calling the second level occurring at 1854, and the first level of real resistance at approximately 1832. Of course, right now there's minor resistance at current pricing. Another way to view current price action is to convert the candlestick chart to a Heikin-Ashi chart, which we have just done and put up on the screen. What is most attractive to me in terms of looking at this as a potential bottom is the pivotal candle that formed today. It is a very small-bodied green candle. That's a doji-like candle, meaning the open and closing price are very, very close together. And that, of course, is occurring after 3 solid days of strong downward pressure. All 3 candles contained an absence of wick, but what was most important is we had body size reduction over that period of time. So that, to me, adds more confirmation that we have found a bottom at the recent lows of 1784. Another way to use a Heikin-Ashi chart is, especially in alternative patterns such as the compression triangle that we spoke about yesterday, because what tends to occur is that when it is in a impulse wave, meaning in this case moving up in an uptrend, what you will see is a series of solid green candles. Reciprocally, as the market corrects, you get that solid span of red candles, and towards the end of those moves, you tend to get your pivotal or doji-like candles. Now, once we are positioned, and as I said, I'm looking to enter the trade between 95 and 90, 1795 and 1790, and then we want to start to chart the various subwaves that will appear in this fifth wave. If this model proves to be correct, and that's what I'm most excited about, that means that it is necessary to break above current resistance. That's what the fifth wave should do, and Elliott wave is labeled that a thrust, the point in which it moves past this resistance line. In terms of our upside targets, of course, we talked about these recent highs that came in at 1851, 1873, and of course, to me, the brass ring right now is approximately 1920. But we've got a long ways to go before we hit that particular area. First, we have to position ourselves properly, and then we can begin to calculate a couple of different models to ascertain where the market might run to before it corrects and where it would go into its third wave when it would break above current resistance. This has been Gary Wagner wishing you, as always, good trading. We will speak to you tomorrow for the next daily update and review. Bye-bye.